You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com, Inside spelled I-N-S-I-I-D-E. Welcome to the show, Eric.
Hey, it's great to be here, Jim. Thanks for having me back.
Gold and silver, after sitting on the shelf for 2 or 3 years, finally moving upwards, 14% up in the year so far. How does that go against your charts?
That is such a perfect fulfillment of what we were discussing back in third quarter of last year and right into January of this year. There were two primary expectations I had for the initial surge in particularly gold, but gold and silver. And both of those expectations were related to past rallies that gold had seen. It's linked to an indicator I call the foreshadow. And back in September and October, I did several publications about this. And basically what I was looking for then, and it kind of gives you twofold expectations, something that's going to happen right then, and then what that becomes a precursor or a foreshadowing of a little bit down the line. And at the time, gold needed to exceed its two previous rebounds in both price and time. This was back in the July through October advance. And if it did that, which it ended up doing, that would anticipate one final leg down. And that's also why, if you saw it written out, the indicator is the number 4 and then dash the word shadow. It's because it's also a fourth wave based on Elliott wave terminology. It's the final high before final decline, or the last low before final advance. But anyway, you see that advance. It exceeds the previous couple of advances, so it tells you there's some underlying strength. Typically that's followed by one final retest of the lows, maybe a spike low, and then the ensuing rally takes out the time and price or magnitude of a larger degree rally, in this case the largest rally of the last 3 years. So when we came into late December and I had the buy signals triggered in gold and silver that we talked about, the primary objective for me was to see gold create its largest advance in 3+ years. And for it to do that, it had to rally into mid-February, and it had to get up to 1258 basis, the April futures that I'm watching. Well, just in the last couple of weeks, gold extended this rally into middle February, and it spiked up to a little over 1260, perfectly fulfilling both of those objectives. And that was also when I expected to see an initial top. But it tells me a lot about what to expect now over the next 6 to 12 months. And so it's already building an entire scenario that I'm monitoring, and that involves a correction into late February, early March, and then another wave up into May. So all of what we've seen in gold and silver recently has really very precisely fulfilled what was described back in September and October, and then reiterated in December and January. So it's also just confirming to me that 2016 is and or will be the golden year, as I've dubbed it for the last couple of years.
Now, this rally for gold and silver, this isn't going to be one continuous line going upwards, is it?
Absolutely not. And I have even discussed where you could even see later in the year something where gold and silver stocks might make it back down to near their lows and really frustrate traders. But I would expect to see a divergence in the metals, and by that I mean that gold would pull back, would see a significant correction probably in the third quarter of this year. But it would bottom out well above where it bottomed back in December, around the 1045, 1046 level. The subsequent low, I think, would be a much higher low, and that divergence with gold making a higher low and possibly the XAU index, or at least some specific gold and silver stocks retesting its lows or setting new lows, would be the perfect setup for a more sustained advance starting in the end of 2016, but then carrying through 2017 and 2018. And I definitely think it will involve a lot of volatility. It's not going to make it easy on the gold bugs, and it's going to try and keep the gold bears as interested for as long as possible before they finally throw in the towel.
In other words, for people who feel kind of a panic situation where I better get into gold now, I'll never get in there, it sounds like there will still be opportunity.
I think there will be, as long as you're willing to buy it where those opportunities present themselves, rather than the classic, if it just gets back down to where it was last December, then I'll buy it. And instead it bottoms out, $30, $40 higher. Well, then it rallies for $50, and then you say, I shouldn't have got so greedy, so if it just goes back to where it was a month ago, then I'll buy it. Well, it pulls back half of that and then rallies to new lows. And you get these, chasing, and those are the ones that usually end up throwing in the towel and buying when it's accelerating into a top. So yeah, I think there will be other opportunities, but I think you need to be very clear on what you're expecting, not expecting too much to the downside, where your risk is, and money management parameters. They all are very important for trades. It's not just a buy and hold type of thing.
What about some people who are projecting there'll be such a demand for gold in the not too distant future, the price will hit $5 or $10 an ounce?
Well, I think those same people, or ones very much like them, were saying it in the early 80s and the mid 80s and the late 80s and the early 90s and the mid 90s and the late 90s. Sooner or later the broken clock is right once or twice. There's no denying that. And I think there will come a time when you do see a parabolic move up. But for me, timing is everything. And, in 2011, you were hearing the same thing just as gold was peaking. Well, it was going into the stratosphere. There was no way, it would ever go back down again. And silver, which, it was hitting $48.50 an ounce back then. Well, it was going to be at triple digits by 2012, and then triple digits by 2013, and then triple digits by 2014. Sooner or later, that will ultimately, it might happen. Silver's got other things to contend with that gold doesn't. But timing is the real critical aspect, and where and how to get in. It's not just buying because you think that's happening. It's where you're going to buy and where it's a good reward to risk investment.
We'll have more with Eric Hadik right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Eric Hadik. Eric, what are the cycles on oil?
Well, that's another topic that we've talked about several times, and I know that I was including some of my analysis on the Canadian dollar, since that's of greater interest to you and a lot of your listeners. But the same thing that I've said since mid-2014 was that I thought oil and also some related currencies like the Canadian dollar and the Russian ruble would plummet into early 2016. The cycles that I have in crude bottomed in January 2016. There are related cycles I have in heating oil that show a bottom in either the first or second quarter of 2016, and that would certainly be a possibility once the winter months are through if there's a dip that allows heating oil to retest its lows. And at the same time, the Canadian dollar in my work has had the greatest synergy of cycle lows, so that's when I would expect a final low and would expect things to turn more bullish, is in March or April of 2016. So it all kind of tells me that we could see a developing bottom, first in crude, then some of these others, starting in January, becoming a bit more pronounced in March and April, and then seeing a more sustained rally in the latter half of the second quarter of this year, so in that late April, early May, and then into June time frame. And crude got down to some critical levels. It was even interesting to me reading back over some of the fundamental analysis I had done back in 2014, and a statement or a quote from the Saudis, and I think it was from Prince Bandar, who was really wielding a lot of power in Saudi Arabia at the time. And the gist of it was that they could withstand oil as low as $25 a barrel. They had enough of a backlog or backup in, their treasury. Well, what do you know? Crude gets down. The front months were spiking down, I think, in the $26 basis. And so you kind of knew all along that was should be the absolute extreme floor before everyone starts to get concerned. When it was dropping below 60, there were certain nations getting concerned, below 50, below 40, more people on board. But once you get down to that $25 a barrel, you've got pretty much everyone concerned. And so that just really helped to validate the cycles that I've talked about for a couple of years now, coming into play in January of 2016. And now the real objective or the real key thing is to get price action, not only providing the potential for a low, but starting to signal a reversal higher and the onset of a new advance. And I should throw in there too that one of the things that I have discussed in the 2016 Golden Year reports that I did back in 2014 and early 2015, and also in a lot of this crude oil analysis, is that I also have long-term, multi-generational geopolitical cycles that were coming to a head, on a collision course in two specific nations, Syria and Saudi Arabia, but also in the Middle East as a whole, beginning in 2016. And as we have approached this time frame, it has been very interesting to see some of the behind-the-scenes speculation and suspicions of some of what's going on, and that there's a real power struggle smoldering in Saudi Arabia, and it's just been exacerbated by oil plummeting as it has, and that it would not surprise me at all to see some sort of upheaval there in 2016. And often the markets give you some important clues as to when that is more likely to occur, because often a related market will bottom beforehand and will start to give signs of an uptrend, and then one of those key fundamentals kicks in, and that's when the uptrend really takes off, which is why, to me, watching the charts and technical analysis is so critical, because by the time a fundamental like that hits the news wires, it's too late to get in. You're usually buying the top if you panic and call your broker at that point and, buy me this or that. Well, a flood of buyers have already driven the price to astronomical levels, and usually they're going to overreact anyway, and that's why technical analysis and cycles are so critical, because they reflect things that the market is digesting but not yet revealing.
Some analysts I've listened to lately are pulling up charts from the 80s, saying we're kind of in the same situation. The numbers are almost parallel.
Yeah, there's some similarities, and when oil plummeted, funny enough, I had moved to Houston, Texas, shortly after that time. I moved there in the mid-'80s, and oil had already plummeted, and so that whole correlation is vivid in my mind in many respects, and it was just interesting to see the real estate collapse there, and this time it would be in a lot of other areas, but what that triggered in the ensuing years, and there are some similarities, and even if you did have some sort of upheaval, I'm not saying that it's an all-out meltdown in the Middle East, but just enough to breathe some life and create some uncertainty that crude moves up to a bit higher trading range, and it would take some time for a sustained, $40, $50 advance to really get legs and get going, as opposed to just some brief spikes on different news. So it is going to take some time, just like in the 80s, to bottom out, get a whole bottom forming, and then start to sustain a more significant advance. But there are definitely some similarities, but also some very strong distinctions as well.
On the equity markets, what I'm seeing so far in the new year, you'll see several steps down, then one good bounce back up, and then some more steps down. Is that going to be a continuous pattern over the next while?
Yes, I believe it is. I have, since late 2014, when I described this whole 40-year cycle that I thought was culminating, I said that I thought the next decline, which I was anticipating for 2015, 2016, and even some carryover possible into 2017, would look more similar to the drop of 2000 to 2002 than it would to the decline of 2007 to 2009. Now, I have many readers that take that and then want to make it an exact replica and say, okay, so which month are we comparable to right now? I'm not saying that. What I described, and I went into specifics when I first described this in late 2014, was that I thought it would be a very disguised bear market, and if you look at a chart in the Dow Industrials and just kind of cordon off the period from second quarter of 2000 through third quarter of 2001, so a 15-month or so period, it was just like you described. The Dow would drop for a month or two, spike a little bit below previous lows, and then immediately turn and rally back, often two-thirds or three-quarters of that decline, sometimes retracing or rebounding almost all of it. But it wouldn't head to new highs. So that would kind of frustrate the bulls, and it would turn back down, take a little while, then all of a sudden accelerate back down to the lows, spike a little bit lower, but not follow through. Just as the reluctant bears are finally throwing in the towel and jumping on board, the market would snap back up, and this time it would go to a little bit lower high. And you can see that pattern, like I said, for close to 15 months in indices like the Dow Industrials. Now, the one that was really leading things, the NASDAQ, that was just plummeting back in 2000, 2002. But the dot-com bubble wasn't enough in and of itself to take down all the other stocks. It wasn't until 9/11, a second fundamental shock to the system, that then the bear market really started to become more obvious, and the rebounds were now only, maybe 25 to 30% of the previous decline, as opposed to 70 or 80% of it. And then, you saw one more dive into late 2002. That is, from a general standpoint, the type of pattern I've been looking for out of this bear market. And so far, it's provided an almost perfect replica of that. And coming into this year, when we were talking back in November and December, I think it was, and I was reiterating my outlook that mid-December would start the real trouble in the markets. I also had very specifics with that the first decline, it would be a sharp one into February, but then that would be it for a little bit, that we'd see a decent bounce from there. And when a lot of the indices plummeted into January 20th, they reached some monthly extremes. It's a specific indicator that I utilize, and also support levels for the whole year were reached at that time. And so what I was looking for was a retest of those lows in February, and it shouldn't really follow through very much if a 1 to 2 month bottom was taking hold. And then in the first half of February, we saw that with certain indices spiking to new lows, but the majority of them went back down and retested their January lows, which was also in many of the indices a retest of their August 2015 lows. And then we held there and started to rebound, and those indices have pinpointed some rebound targets, which were still in the process of rallying to. So I think it is going to be, like you say, this kind of stair-step decline. On balance, the declines should outweigh and outdistance the intervening rebounds, but it's not going to make it easy on traders. And that also gives plenty of time for the media to come on, tell you things like, oh, well, we just held the January lows, which held the August lows, so this must be a great place to buy. Well, there's another little axiom in technical analysis that double bottoms hold, triple bottoms don't. And we now have a triple bottom in many of these indices, where a market will give a bounce from that, but if it's tested the level that many times, it's most likely going to ultimately go through that level, and they're the more accelerated moves. When you've built support and retested it that many times and it's held for that long, they're the real definitive levels. So that would be the thing that in the second quarter of this year that I'm looking for, is heading back down to these recent lows and ultimately breaking through them. That'll be kind of your waving the flag that, okay, this is now an undeniable bear market that's been evolving for a year, but no one's been willing to call it that until now.
The way I look at it is, if you poke the bear often enough, it'll get angry.
Exactly.
Eric, thank you very much for chatting with us.
Thanks for having me back, Jim. Always a pleasure.
My guest has been Eric Hadik, president of InsideTrack.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Godry.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.